You can't go into a trade war with the world's factory as capital controls without putting on significant capital controls yourself. It's just a fact. That's probably what happened. Is like we put those capital controls in, gold goes to the moon, Bitcoin goes to the moon, stocks tank, bonds tank, dollar tanks. 5 days later, bond market breaks, Fed comes in or Treasury comes in, and then stocks go to the moon, bonds, Bitcoin and gold go to the moon, even more. And I think that's probably actually where we're headed. In the context of this conversation that we've been having with our clients about these capital controls, I've said multiple times that Bitcoin might be the most perfectly designed asset in history to avoid capital control.
Luke Gromen, founder of Forest for the Trees, is a leading macro strategist known for cutting through noise to spot global economic shifts before they hit the headlines.
With 25 plus years in equity research, sales, and thematic analysis, he helps investors connect dots and navigate market bottlenecks.
The Fed has not sold a 10-year Treasury on net since 2010. So as they've gone through two different rounds of QT, taper and QT since then, and on net they've sold no 10-year Treasury, which I think is super important in the context of. So they're into this vortex of, the 10-year market's not liquid enough. We need to sell more at the front end. That's inflationary. Well, that's not going to make people want to buy more 10 years. So they've got to wash, rinse, repeat. And
Hey guys, welcome back to Less Noise, More Signal. Today we have the one and only Luke Gromen with us. Luke, it's amazing to have you with us. Thank you for coming on.
Thanks for having me on, Pascal. It's great to be here.
Yes, amazing. Yeah, obviously I've been a huge fan of yours. I've binge watched so many podcasts, episodes that you did with other people, other podcasters and stuff. So I'm highly familiar with you, but maybe there's one or two Swiss people who might not be familiar with you. So if you could quickly introduce yourself and who you're with, that would be great.
Of course, yeah. I'm the founder and president of FFTT, stands for Forest for the Trees. I founded it 11 years ago after having spent nearly 20 years in finance doing investment research, bottoms-up, fundamental, channel check-based research. Was the editor of a couple different macro-type products where I was essentially with another colleague of mine connecting dots from the bottoms-up fundamental survey work we were doing and crafting macro research products out of that were pretty popular across Wall Street, and so hung on my own shingle in 2014, and I connect dots. I aggregate a large amount of publicly available data from public sources, of course, and try to connect them in a way to identify developing economic bottlenecks, which is to say, I'm looking for who's going to benefit from some sort of jam and or be hurt by it. And we focus on various sectors. Done a lot of work on what I think is the biggest and has been the biggest sort of jam or bottleneck, economic bottleneck, has been the fiscal situation in the reserve currency issue of the world, the United States. So that's sort of the quick 30 seconds on my background.
Nice. Yeah, that's amazing. Well, and we're surely going to link to your website and everything in the show notes so people can check it out afterwards. But I think, yeah, you've been so popular on all these macro shows, and many people have been profiting off your knowledge and your insights. And so I want to pick your brain today as well. And maybe no better way to start with these global affairs that are currently happening. I feel like with the whole tariff situation, but in the last few days, even, I guess there's been sort of this backtrack from this maximalist tariff strategy that was presented to us in April, and now it seems to be it's really like this great backpedaling happening by the Trump administration. Are you seeing this as well, or how do you interpret what's been happening the last few days?
I think there's two interpretations, it seems like, over here in the United States. One is the Trump supporter, which is this was the plan all along, and this is, if you want a dog for Christmas, ask for a pony. Start from a maximalist position and work back to where you actually want to be. Maybe. I think there is an alternative explanation that is more nuanced, that I am leaning towards, which is essentially, I do think that was maybe the Trump administration's start. They wanted to run that strategy. Trump is sort of known for that. I don't disagree with that. But what I think surprised them were a couple things. I think number one, the reality that the U.S. Treasury market dysfunctioned in about 7 trading days after he did this, I think showed the Trump administration they don't have exactly the economic hand they thought they had. And then the other thing that is, I think, still less appreciated by Wall Street, because we tend to just focus on, in the investing world, financial dynamics. But I hear very credible rumblings from multiple different people that China cutting off rare earths to the United States was a much bigger deal than was let on, or than is being let on. You're starting to see it a bit in the media now. You've seen a couple headlines over the last couple weeks. But I think those two things boiled down was Trump didn't have the economic situation he thought he had. Trump didn't have the military situation he thought he had. And so now it feels a little bit like, trying to, orchestrate that this is all part of the grand plan. And I don't think it is. I think the grand plan was he was going to back down on his terms. There's a little bit where they are, but I think there's some parts where they're not. And they don't have the leverage they thought they had in some really important areas. And that kind of brings us to today, which is, okay, now what?
Yeah, that's a great point. Yeah, I mean, I sort of had the feeling that the Trump team, or at least that's what I'm also getting when I'm talking here to other people on the trade floor here throughout Switzerland and Europe, that he's sort of now tacitly acknowledging that his strategy of restructuring the global imbalances that he points to correctly through this current account deficit channel, with the tariffs, that this won't really cut it, just because maybe out of various reasons, because tariffs are going to be inflationary after all, even though Beston and everyone has been calling for no, they're not. And also the tariff arbitrage that can potentially happen if you don't go through a unified tariff rate on all the country, which seems like he can't be doing right now, out of geopolitical reasons or whatever. So I don't know if you have any thoughts on this, but it feels like this tariff strategy, it's just sort of him tacitly acknowledging that this might not be how he can sort of curb down these imbalances that he must probably, right?
Yeah, I think I agree there needs to be a rebalancing. I agree they've identified the issue, or one of the key issues. It's not the only issue. But they are identifying and trying to attack symptoms and not the fundamental problem. And as a result, a lot of what they're trying to accomplish are contradictory, right? So, perfect example, Besant wants oil down. Great. Well, to support the Treasury market and to refinance the debt. But if you do that, you're going to get about a very brief moment in time where that will work. And then shale production in the United States is going to roll over quickly. And quickly in the grand scheme of things, in the next 3 to 6 months, oil prices are going to stop going down because U.S. shale has been 80-90% of global oil production growth. And over the last 10 years, and Saudi and Russia are going to control the oil market de facto for the next several years, because it would take, best case, much higher prices, several years for U.S. oil production to return to peak, just given what we saw after 2019, what we saw after 2014 in prior local peaks in U.S. shale production. So that's just one example. Trump wanting the dollar down through this America First investment policy memo he came out with on February 21st, are basically saying, look, China, we don't want China in our markets as much. We want China to consume more. So this America First investment policy memo says, basically, China, take your money and go home. Well, okay. And that will weaken the dollar, but that's also going to send rates up, which is contradictory to Besant wanting to get rates down. And it's going it's going to create stocks down, which is going to blow the deficit out. And that's contradictory to the desire to reduce the deficit. You're to more than offset any little bit that Doge did if you get stocks falling for any sustained period in this country. There's a very clear relationship on a slight lag between stocks go down, federal receipts go down. This is the system they've created for themselves. So that's why I say they're attacking symptoms and not the problem. The problem is like really simple to fix. Like I could fix the problem for them of imbalances in a day. It's the easiest thing in the world. You want to fix the problem. The problem is the currency. The problem is the dollar. The dollar is wildly overvalued by virtue of its status as global reserve currency. And this is another one of these contradictions. They're like, well, we want it to stay global reserve currency. We want to keep being able to do all the things that this gives us on a geopolitical PowerPoint. And we also want to get rid of the the haircut or the handcuffs that it puts on us on trade. Well, like that's the deal. Like you lose on trade and you win on this geopolitical power thing. And they want, no, we want to have our cake. We want to eat it too. Like the way that the fix is simple. Politically, it's very hard, but mechanically, it's the simplest thing in the world. That is, you find a neutral reserve asset, you settle deficits in that, and you let it float. That's it. So, for example, I've been saying this over and over. China ran a $900 billion surplus in goods with the world last year. China imported 1,384 tons of gold last year. All in. That is all in. You do the math at that $22,000 per ounce of gold, China ran a flat trade balance. And so you let gold rise dramatically, China's trade balance would fall dramatically. The problem, it's not a problem, it's a political problem for some people, but not for everybody. It just depends, which side of the street you're on. The problem is $22,000 gold or $10,000 or $12,000 or $15,000, whatever number would actually sort of, I don't think you'd have to go all the way to 22. That's just straight math. The dollar gets hammered, right? At $10,000, $15,000, you're going to wake up and the yuan dollar is going to be 2, 3, 4, I don't know, but it ain't going to be 7.2. It ain't going to be 6, probably not going to be 5. So the yuan would have to rise meaningfully. That would end China's mercantilism almost immediately. So there'd be a problem for them as well for a huge part of their country. The offset for them would be that everyone there, banking system, sovereign, etc., hold a lot of gold, individuals. And so they're going to wake up with a lot more spending power. Then they can sort of do whatever they want with that. The U.S. will have the other side of the same coin, which is we're going to have to make a lot more of our own production. And that's going to be wildly inflationary. So like the fix to what they're trying to do it's easy. It could be done in a weekend. Mechanically easy. Politically, it's very complicated, but that's the fix. You like all these other things are attempts to address symptoms rather than the fundamental issue, which is the dollar's wildly overvalued and we need a neutral reserve asset.
Yeah. No, I see. I get that completely. But I mean, I was always wondering why they focused on this, like sort of the current account deficits in the first place, because like there's the mirror image to this is sort of the capital account surplus, right? And this is exactly at the core of the issue that sort of there's too much demand for U.S. assets. Let's put it this way, at least like when it comes to then also stocks and stuff. And that's also what the administration has been fearing, right? That like a larger chunk of its economy is going to be owned by foreigners, and they probably don't want this as well. But then my question was always, if you go down this tariff channel and you try to pull that lever, you're affecting the real economy, like probably in a bad way. Why not go down the capital control route? Wouldn't that be sort of more isolated in terms of you're really trying to pull one or two levers when it comes to the whole financialized markets with that? And so you have any thoughts on this? Maybe also capital controls on foreign investors and foreign U.S. bondholders and stuff. So to make sort of U.S. assets less attractive, and that way you get a weaker dollar automatically as well. This show is brought to you by NewHedge. In a market driven by complexity, insight is everything. NewHedge is a dedicated Bitcoin analytics and intelligence platform delivering cutting-edge analysis, on-chain metrics, and real-time market data. With 200 plus proprietary indicators, live derivatives data, and adoption metrics, NewHedge provides the depth and precision that serious market participants demand. Backed by some of Bitcoin's most prolific investors, NewHedge connects traditional finance with Bitcoin's evolving landscape. Gain your data edge today. Sign up for free now at newhedge.io and get 50% off your advanced subscription with the code SIGNAL.
I think they're moving in that direction. I think they started with tariffs because Trump's loved tariffs and he's been talking about tariffs for 40 years. But if you kind of read between the lines of the America First investment policy memo, they're talking about increasing withholding taxes on U.S. Treasuries. You hear, that's raising cost of carry. That's a capital control. I think there, a gentleman, an investor named Michael McNair. I encourage people to look up, just find him on Twitter or X. He's written a number of different really good articles in great detail on this subject around managing the capital account by virtue of and raising revenue by virtue of basically taxing capital inflows that we deem inappropriate or we deem not attractive to us. So I think they're moving that direction. And there's two issues there. Number one, if you do it too fast, you're going to crash the stock market, or crash the bond market, you're going to send the dollar down. You're going to drive literally a sudden stop in the world's reserve currency. An emerging market, sudden stop, currency crisis, a la late 1990s in Southeast Asia. In the United States of America, so much of our tax receipts are tied to stock prices. So much of our consumer spending is tied to stock prices. You can see, we've done the work. You look at IRS data, our Internal Revenue Service tax data, net capital gains plus taxable IRA distributions are 200% of the annual growth in personal consumption expenditures and U.S. consumer spending, which is 2/3 of GDP. So, and that doesn't include executive comp, which is taxed as ordinary income. So the point is you literally cannot have consumer spending mathematically grow in this country if you don't have stocks rise 10 to 20% a year. And so here too, they're in this fundamental contradiction of what they want to achieve in the long run versus, it's not just do they want to take the pain? They literally can't take the pain. Like if they put this in place with U.S. debt to GDP still at 120%, they will crash the Treasury market. You will create a dysfunction. You will force the Fed to basically buy a big chunk of it leads to a very nonlinear decline in the dollar. It will be dollar goes 100, 95, 70 on the DXY or 65 in like a month. And that's destabilizing. So I think that's part of the issue is I think they know they need to change the capital flows, but I think they're trying to figure out how to do it in a gradual way that doesn't undermine the economy. And the reality is there's no real way to do that. There's just not. And so that leads to a couple conclusions. Conclusion one is that if it's going to happen, it might happen over a weekend. Like everybody thinks, well, I'll adjust there. It might happen over a weekend, like they did in under Nixon in 71 in August. And so I think that's like this challenge, this challenge of how do you do it without actually having to suffer, the pain.
Yeah, exactly. That was well described. It's really this these dependencies that exist, and are so complicated and Byzantine, and that makes it so hard for them to pull something like this off. But exactly as you described, at the margin, U.S. capital gains taxes, on stocks are probably, as I said, a marginal revenue driver of the government, and so it's so hard to sort of pull this off. And it is this inherent contradiction that you pointed out. I'd be still curious to hear your thoughts on. There's this other macro commentator, quite popular in the crypto space, Arthur Hayes, and he had this recent article where he laid out his theory that it would be way better for the US to just apply a 2% foreign capital tax on all stocks, bonds, and property, and so I'd be curious, do you think something like this could happen as well? Or is this too far-fetched to think about something like this
No,
happening?
I think it's very possible that it could be something like that. I mean, it's, there is not just mathematically, it makes sense. Again, you're going to introduce some sort of capital outflow dynamic, somewhere, to basically everywhere else. But I think especially to gold and the Bitcoin as well. I think those two would surge on the announcement of that, like massively, which isn't necessarily a bad thing, right? The U.S. government has sort of placed itself in a position where, with stable coins, where the higher Bitcoin goes in price, the more there's going to be some T-bill demand that they can avail themselves of. But there's a geopolitical issue, which is once you do this, like the rules of the last 50 years is the global reserve currency, the dollar, can't have major capital controls like this on major trading partners. Like that was the deal. You make stuff for us, we send you dollars, you send the dollars back into our financial markets. And, the Chinese in particular, others started sort of, it's a he said, she said. The Chinese will tell you we broke the deal in '08 when we printed the money instead of going through a restructuring of our banking system. They have a very valid point because we enforced that through the IMF on sort of everyone else that had gone through what we had gone through prior 30, 40, 50 years. But we said, we're America, we're just going to print the money. The Chinese like, okay, well, after this is all settled down, we're out of here. We're going to start taking the dollars and we're going to stop buying treasuries. We will still buy some mortgage backs, but we're going to buy stocks. We're going to buy ports in Greece with our dollars. We're going to buy oil fields. We're going to buy, commodities, gold, and anything but basically anything but dollars, anything but treasuries. And that's what they've done. So, the U.S. broke the deal by printing the money in '08 to get out of it. The Chinese then broke the deal by basically stopping buying treasuries and starting to sell treasuries and redeploying their surpluses into, basically running a giant squeeze on the dollar, a run on the dollar, right? Which is, everyone's always known forever that there's not as much oil and gold and all this stuff as there are dollars being emitted by the U.S. And sort of everyone agreed that, by sort of mutual rules-based global order, like no one's going to circumvent the U.S. and start just buying this stuff up on their own. And the Chinese are like, all right, well, you broke the rule, so we're going to break the rule. And that brings us to this point of, it makes perfect sense then for the U.S. say, all right, well, if you're not going to abide by the rules, then we're gonna not abide by the rules too, again, which is capital controls on stuff into our markets. That has a geopolitical implication of the dollar's reserve status is basically will be relegated to gold at that point. Gold will be reserved, dollars will not be, because Europeans can't have it. And the Chinese don't want it. It's not like people are going to switch to European bonds or Chinese bonds or British bonds or Japanese bonds. There's no one else out there can do it. So it's going to go to gold. Gold's going to go to the moon. It's probably actually in U.S. interests in a number of different ways at this point. But until the dollar gets weak enough to really bring back foreign direct investment here, there's a period of time politically where the people are going to be very unhappy because they're going to come in every day and stocks would be down and until the dollar was weak enough that, there's a possibility. It's very possible that really the Fed just is forced to the Treasury market breaks in 5 days, stocks go down for 5 days. And quite honestly, as I talk through it, that's probably what happened is like we put those capital controls in, gold goes to the moon, Bitcoin goes to the moon, stocks tank, bonds tank, dollar tanks. 5 days later, bond market breaks. Fed comes in or Treasury comes in, and then stocks go to the moon. Bonds, Bitcoin and gold go to the moon even more. And then it can kind of work. And I think that's probably actually where we're heading.
Yeah, I see. You mentioned gold going to the moon would be net positive for the U.S. government at this point in time. Can you maybe elaborate your thoughts there? It sounds interesting as well.
Yeah, two reasons. Number one, the dollar's reserve status is no longer in our interest, as it's been structured. Basically, if that's kind of what we've been saying with this. So it's why are we trying to tell people stop buying our stocks? Well, it's because we literally can't make. We just saw in Ukraine. Yeah, Ukraine was over the last 18 months. It was an American war. It was the American strategies, American weapons, American tactics, Ukrainian men. And the Russians won. They won going away. They're winning, full stop. And they're going to keep winning. And part of the reason they are is the U.S. and NATO more broadly can't produce enough weapons. We're getting outproduced by the Russians. Why? Because our industrial base, a quorum of it, is sitting in China. And China is, all else equal, supporting Russia. So the U.S. military has known this for over 10 years, that the dollar structure, the dollar hollowing out our industrial base has become a national security threat. And COVID proved it the first time. Ukraine is absolutely proving it in spades. The United States cannot credibly project conventional power, military power against Russia or against China. We've seen that. We know that. So that's one reason why, okay, well, you need something else. The only other something else you can go to, practically speaking, is gold. So that moves us in that direction. The other thing is more mechanical, which is at a high enough price of gold, there's this mechanics where Treasury Secretary Bessent can can revalue U.S. gold certificates to whatever number it's trading at in the market. And that action creates a deposit free and clear of cash into the Treasury General account with which he can do whatever he wants. So at $3,300 or $3,250, where we are today, that's like $900 billion. Goes to, it goes to 6,000. It's like $1.5 trillion, $1.6 trillion. It's basically $1 trillion for every $4,000 in gold's price. So if we were to wake up and gold really go to the moon, $10,000, you're talking about, $2 trillion, $2.5 trillion deposit into the TGA. For a country with a fiscal problem, with a dearth of buyers at the long end, that would ensure that for at least the rest of the Trump administration, if not longer, they wouldn't have to issue any debt at the long end. So paradoxically, gold going to 10 or 12,000, the dollar would get hammered just mechanically. But you could actually see long-term U.S. Treasury yields fall a bit. You could see the 10-year yield go from where are we at this morning, 4.55%. It could go down to 3.8%, 3.7%. I don't know that it goes a lot lower than that because dollar weakness probably precludes it. But it would mechanically create an ability to it creates a deposit in the Treasury General account, free and clear, without an offset of debt. It would give the U.S. If it went to a really big number, say it went to 20,000. Again, that's not my base case, but if it did, he could go out and that would create, I don't know, $2 trillion $5 trillion into the TGA. Like he could go out and buy a quarter of the Treasury market back, like overnight, which it would be wildly inflationary. But between the nominal increase in GDP and the decline in Treasury stock outstanding, the U.S.'s debt to GDP would go from 120% to 70%, 80% overnight. And now all of a sudden, all these other things we were talking about at the beginning that were highly disruptive and why the Trump administration had to backpedal, because the debt blew up on them after 5 or 7 days, the debt wouldn't blow up anymore. They would have a lot more leeway to do some more drastic things, some more restructuring, without the Treasury market being the vulnerability to them that it has been.
Yes, I see. Very interesting. I think we can also drag Bitcoin into this picture, right? Like when we talk about gold being elevated to becoming this neutral global reserve asset, I mean, there's probably also a role for Bitcoin to play here. And I heard some people say that they see a world where the sovereign imbalances can be flattened with gold, sort of, and then the private ones is probably with Bitcoin, because Bitcoin is not as entrenched with sovereigns just yet. It's maybe with corporates and institutions, but not with the sovereigns. And so my question would be, do you agree with that statement? And then also, maybe what could that flattening look like? Concretely, is it just like gold and Bitcoin going to the moon, as you said? Is that it?
Yeah, I agree with that statement. We've for a long time we've said I think the gold is a neutral reserve asset, energy linked, and Bitcoin is a neutral reserve, energy linked asset for the people. And So I agree with that. I think we're moving in that direction, organically, and I think via policy, certainly versus gold, and then some of the sovereign wealth fund buying a little bit on the margin of Bitcoin that you've seen. Yeah, and at the end of the day, like price will solve this whole problem. The right price at gold, China's mercantilism that angers America is over. And our inability to compete in manufacturing is over. It's just, we're in this, it's like the 5 stages of grief, right? It's denial, anger, bargaining, depression, acceptance. We've gone from denial. Now we're in sort of the anger and bargaining stage of this whole process, which is we want to be able to make stuff again because we literally got outproduced by the Russians 4-1 in Ukraine, according to the Secretary General of NATO. Okay, we want to make more. Well, we need a weaker dollar. Okay, well, we need a weaker dollar. How do we do that? Oh, but we don't want to give up this other hand. So there's this bargaining dynamic that, ties back to what we led off the interview with of, Trump backpedaling and Trump trying to achieve these contradictory goals. There's this bargaining of like, well, maybe if we take the tariffs down or we do this, like, no, the answer is simple. Neutral reserve asset to the moon, settled imbalances in it. And that's where this is gonna go. The only question, in my opinion, is like, can we do it without World War III? And how long will all of this take? And I don't think it's gonna take that much longer, just because we're like into year 10 or 15 or 20, depending on how you want to measure it, on the stopgaps to preventing this from happening. So I think that's where this is going. And yeah, it's gold and Bitcoin mooning.
Yeah, exactly. That's what I was going to ask next. Like what time frames are we talking here? That's always something that I'd be curious as well. What time frame do you have? You said something like this could be happening real quick, or is it really this gradual staircase, inflating sort of every now and then, Bitcoin and gold going higher, or and all within 5 years, or maybe in the next 20 years, or what's the time frame here?
Yeah, that's always the tricky one, right? I mean, look, this process has been underway for at least 25 years already. When the euro was founded, they put 15% of gold into reserves, 15% of Eurozone reserves into gold, and they marked it to market quarterly. So basically, that was an affront to the U.S. That was a desire to create an oil currency so that the Europeans could print euro and buy oil and commodities in their own currency. And Saddam took advantage of that. He obliged them for at least a few years, and we know how that went. The Russians started obliging the Chinese. Hey, yeah, we'll sell oil in yuan, sure, and we're going to put money in gold, not treasuries, from our oil surpluses. And it started sort of 2008. The gold, and then by 2015, 14, it was announced they signed a big oil or gas pipeline deal that was being done outside the dollar, or maybe 13. And so this process has been underway, and it's kind of waxed and waned. But what you can tell is the gold to oil ratio is a metric for sort of the progress on this. And so when this process started, and arguably in 2008 really went accelerated, gold bought 7 barrels of oil, it buys 60 barrels of oil now, right? So that is exactly what you'd expect to see if the multi-currency energy pricing with net gold settlement system that we are evolving to was gaining traction. If it wasn't gaining traction, gold would still buy 7 barrels of oil, and that would be that. And so, when you look at prospective timing, look, I think the Ukraine war was a huge, this outcome of this Ukraine war is a huge deal. And the fact that we're moving toward peace in theory, I mean, Russia says they're willing to talk. Trump wants them to talk. The Chinese want them to talk. The European capitals seem to want to, keep this thing going. I don't know why. But I think the fact that we're moving toward peace, because I think this proxy war was ultimately about trying to tip over Russia. And why would we tip over Russia? Like, I Putin is what he is, but I don't think anyone would give a crap about what he's doing if he would sit there and do what Yeltsin did, which is basically sell off the country piece to the Americans and the Brits for dollars. And, he won't do that. And so it's a threat to the status quo currency system. But the status quo currency system is a threat to us now, too, to the America. So, like, I think it's part of the reason Trump's going, like, why are we fighting this war? This makes no sense. Like, he's literally trying to move things in the same direction we are with what we're doing. So, I think ultimately you're going to see major changes to the monetary system over the next 5 years for two reasons. Number one, the Chinese want it, the Russians want it, the Americans all want it. Europeans say they don't want it or acting like they don't want it, but they quite frankly don't get a vote anymore because if we pulled our troops, there's nothing that you can do about it. The other dynamic is when you look at the debt dynamic in the U.S., and again, I pick on the U.S. because it's the global reserve currency issuer, we're at 100% of peak receipts, all-time high receipts, where true interest expense 100% or near 100% of all-time receipts. So interest plus entitlement payments, the interest-like obligation, are at and receipts are at all-time highs, and tax receipts as a percent of GDP are near sort of all-time highs. So it's not like we can, well, let's just raise taxes. Like, you can raise tax rates as much as you want in America. You only ever get really 18.5% of GDP in receipts. So you got to grow GDP to grow receipts from here. And you're only going to do that by like triggering a huge stock bubble again, because that's the key marginal driver to GDP, like we talked about before. So, and you can't do that with a stronger dollar. You need a weaker dollar for a super bubble. So when you put all of these factors together, that's why I say, I think in the next 5 years, we're going to see major changes. And I think we're going to see major changes during the Trump administration. Well, what does that look like? I think, we'll see some sort of, when you have the price of oil, the gold to oil ratio go from 7 barrels an ounce to 60 barrels an ounce over 15 years. That's a slow part of the change. I think we're going to go through a part of the change where it's going to go 60 barrels an ounce to 120, 200, 400 barrels an ounce in, 3, 4, 5 years. That's what that'll look like. And I think Bitcoin will sort of follow commensurate with that, probably with more volatility and more upside. But that's, people keep waiting for the system to change. Like, there's got to be this, no, if the dollar system changes, then, you got to have the zombies. There'll be a zombie attack and, the world ends and everyone's going to, like, no, like, these systems change and they can change like that. Like, and so to me, we're moving toward the moment where it could happen over a weekend. And there's a lot of complacency around that.
Yeah, so interesting. I mean, as I hear you, it's really like the vindication of what we're talking here is really when these hard assets are going to go up in price, and so my question would also be, how do you think about or how do you juxtapose these two? Like, is it just like, okay, because in a world where what we've talked about, with these global capital controls and everything, I feel like Bitcoin being the borderless digital bearer asset transacting on its own rails, like being sort of not on the traditional rails, so to say, should be even a better candidate than gold. But are you thinking about this, or is this just a narrative, or how do you, like, in portfolio weighing these two assets? What is your strategy there? That might be interesting to people as well.
Yeah, I mean, we've been writing in our work, I think 3 out of the last 4 weeks, we've been writing about capital controls. And, we started that whole conversation with, if the U.S. is going to get into an intense trade war with the world's factory, which has significant capital controls, as China does, then it's only a matter of time until either the U.S. loses or institutes capital controls of their own. Like, you can't go into a trade war with the world's factory as capital controls without putting on significant capital controls yourself. It's just a fact. You'll just turn yourself into a source of funds, which was what we were seeing with dollar down, bonds down, stocks down. So I think the capital controls are coming in some way for the United States. We can talk about what that looks like. And of course, I don't think they're going to be called capital controls, because we don't call anything what it is in America when it's it's, Operation Iraqi Freedom was not Operation Iraqi Freedom, right? The Affordable Care Act was not like, in fact, if you did the opposite thing, it is more likely what is actually happening. And so I think, it won't be capital controls. It will be like, ensuring foreign participation in U.S. capital markets for the future, or some, bull crap like that. And what it'll really be is like capital controls, foreign capital controls, which again, will be in our interest. But so I think, in the context of this conversation that we've been having with our clients about these capital controls, I've said multiple times that Bitcoin might be the most perfectly designed asset in history to avoid capital controls. So I agree with your assessment. It is beautifully positioned to benefit I'll say if to be objective, but I think it's a when these capital controls are put into place as we try to use them to restructure the system in a way that is more balanced. So yeah, I think Bitcoin wins huge in that world.
Mm. Yeah, I mean, yeah, gold would probably win as well, but it's just like my point is sort of a Bitcoin not being that old and then not having this enriched history as gold is probably more dependent on sort of narratives, and that's where I can already see a next big narrative being spun up, like when these capital controls hit on a global scale, then it's really why all the Bitcoiners will be all over it again. So that's just going to be interesting for sure to see. I mean, I want to turn to this last topic, the Treasury market. And I mean, you hinted at it already, but maybe just because I saw this graph that you posted a couple of days back, where I think the Fed started to taper in November 2021. And then the graph showed that it still bought like 300 billions of US 10-year treasuries while ostensibly running QT. Can you explain how it did this exactly? Is it through like treasury buybacks? And then also, what does this prove to you?
Yeah, if I remember the chart right, it's from Chris Hamilton at Economica, who does great charts. And so if you don't follow him on X, I would. The chart, I think the reason for it is essentially the reinvestment of rolling off other debt. So basically, as Fed holdings of other debt expired, rather than just let the balance sheet shrink by that much, they were managing it and they were rolling it. Where they were rolling it was 10-year treasuries, right? That's just 10-year treasuries. And so, yeah, they ended up buying during QT on net, like they grew the holdings of 10-year treasuries 300 billion, which I thought was super interesting. I think it was from 1.3 trillion to 1.6 trillion. I thought it was super interesting because it's a topic we've talked about a lot with clients, which is, number one, the Fed has not sold a 10-year treasury on net since 2010, right? So as they've gone through two different rounds of QT, taper and QT since then, and on net, they've sold no 10-year treasuries, which I think is super important in the context of, number one, we had another chart that I didn't put on X, but we had for clients showing that during the period of time, the latter period of time where the Fed bought $1 trillion or 300 billion in 10-year treasuries during QT, foreigners were selling 10-year treasuries. So foreigners were selling, Fed was buying, not selling during QT. And that then as context of a government that came into the year saying, well, Scott Bessent is a markets guy, and so he knows better than the academic Yellen, and he criticized Yellen in 2024 for not terming out the debt, and so this markets guy is going to be able to term out the debt. No, he's not, and that's what we were saying. The reason Yellen shifted issuance forward and didn't term out the debt was not because Yellen was an academic rather than a markets person. It's not because she was stupid and Bessent is smart, and I'm not saying he's not smart. The issue is 10-year treasury market is not liquid. It's not nearly as deep and liquid as everyone pretends it is. And that in turn has huge implication, right? Because that means there isn't going to be a terming out. And if there's not a terming out of debt, I know what to do with that. That's easy. That's okay. anytime they try to term it out, you're going to have market disruption, Treasury's going to dysfunction, and then they're going to inject more dollars. Okay, so I'm going to need to just hedge. If they say they're going to try to do that, hedge a little downside, but eventually they're going to have to inject more dollar liquidity one way or another. And ultimately, it means the United States government, the most powerful government in the world, is going to continue to finance more and more of its deficits at the short end, which is secularly inflationary over time. This is an emerging market type setup, which again, you don't sell stocks on that. You buy stocks on that. You sell bonds on that. And so they're into this vortex of, the 10-year market's not liquid enough. We need to sell more at the front end. That's inflationary. Well, that's not going to make people want to buy more 10 years. So they've got to wash, rinse, repeat. And that's what I think the implication is.
Mm. I mean, that might be a layman question, but just to follow up, why couldn't we go to a world where the US government only finances itself through bills, like moves 100% to short-term bills? Is that a world which is totally unthinkable, or like what's the reason, the basic reason why that couldn't happen?
It's just a question of inflation, inflation and the political reaction to it, right? Like I had a tongue-in-cheek ex post, I don't know, under Doge, when they started talking about Doge. You can lay out, you go, okay, U.S. spends $5.2 trillion, collects $5.2 trillion in receipts, roughly. 70% of that is going to entitlements. 30% of that is going to interest. 20% of that is going to defense. What else are they going to cut? There's nothing else they can cut that matters. Another 20% or 10% of that is going to 15% is going to Veterans Affairs. It's like 135% of it's going to, entitlements, interest, defense related. Great. So my tongue-in-cheek post at the time was like, I could Doge this tomorrow. Like, have the Fed cut rates to zero and issue the entire deficit in T-bills at zero. The reason why that's tongue-in-cheek is that's not quite money printing, but that's like kissing cousins of money printing, right? You're just 0% bills, 3-month bills is basically money printing, especially in America where that stuff can be used as collateral immediately into markets to basically create leverage. So there's no reason they couldn't. It's just a question of inflation, and it's a question of the political response to the inflation. Like, that's it.
Yes, I see. And maybe one of the last questions I'm wondering, because I've seen this floating around as well. Some argue that the financial dysfunction yield strike price, so to say, of the 10-year Treasury bond is around at between 4.5% and 5%. Are you in this camp as well? I assume so, right?
Yeah, I think it's probably more like 4.8, but 4.8 to 5%. But the longer time goes on, the more I would agree with the view that it shifts, that the lower bound shifts from 4.8% toward that 4.5%. I mean, we might be there now. But I do think, the 5%, 4.8 to 5% range that's sort of the upper bound hard limit on that whole dynamic.
Yeah, and I see, and that's why that there's been this guy, I don't know if you've seen it on X, also posting, Mel Madison, and he had this article where he was sort of arguing, well, I mean, a higher yield in and of itself with the 10-year Treasury is a positive sign, because it reflects higher anticipated nominal GDP growth, and so he was like, this increase in the 10 or 30-year yield is essentially meaningless when it comes to government borrowing costs, and should be no cause for concern, because it signals logical equity and nominal growth bullishness. How can I square this circle? Is there any merit to this, or what are your thoughts there?
I think it's a question of time horizon, right? Like, in the immediate term, yeah, he's right. The challenge is that as the 10-year yield is ultimately the real economy policy rate of the United States. And so, in the short run, sure. But if, with the U.S. having whatever it is now, $37 trillion in debt, and what would true interest expense being 100% of receipts already, a 4.6, 4.8, 5% 10-year is going to slow housing markets. It's going to slow the economy. It's going to increase refinancing rates of the private sector across the economy. And that's going to impact receipts. And so now you're into this, this debt spiral dynamic of, receipts are declining, your interest expense is rising, your true interest expense is now more than 100% of receipts. All else equal, that means the U.S. government is going to crowd out global dollar markets, which will send the dollar up. And if all else equal, and as that happens, foreigners will have to sell dollar assets to raise dollars to address their $13 trillion plus in dollar-denominated debt, which as they do that, what are they going to sell? They're going to sell treasuries because it's, you sell what you can, not what you want to necessarily. But they'll sell some stocks too. And stocks go down, receipts go down, treasuries are sold, yields go up. So you're into this, now receipts are falling faster, interest is rising faster. And so that's why I say it's a question of time horizon. Like, yeah, in the very short run, sure, he's right. Get out a month, get out 2 months, get out 3 months. And then it gets a question of, markets are discounting mechanisms. Like, how long am I going to stick around and hold a 10-year where I'm losing money on and knowing the more the yield goes up, I'm moving towards a fiscal crisis, a debt spiral. And so it's that, ultimately the real issue with that number is the U.S. government can't afford it. They can't afford beyond 4.85%. And the closer you get to it, the more sloppy things are going to get.
That's a great point. Well, I think, Luke, I want to be conscious of your time. So I think we'll wrap it up here. Thanks a lot for answering all these questions. Always very nice to listen to you and all the great insights. I think if you don't have anything else to say, I just want to say thank you for your time.
Absolutely. No, thank you. Thanks for having me on. It was great speaking with you, and have a great rest of your day.
Yes, you too. Bye, Luke. Thanks.
Bye-bye. Thanks, Pascal.